IFRS 10, consolidation of certain financial position, profit and loss account and other comprehensive income, and cash flow statement. When company complete acquisition of an asset, subsequently certain event can happen. Now, those events that could happen are when the company, after acquisition of subsidiary, they may decide to repurchase part of the equity of the subsidiary, or they may decide to what, sell off equity that they hold away. Again, a company can also be as an associate and later say that, okay, we are associates, we cannot consolidate an associate company for, so they may later decide to buy more share of that company and become majority shareholder. When that happens, they become parents. So these are some of the events that can happen around company acquisition. So such event is what we call step acquisition. Under step acquisition, we have what we call control to control. Now, under the control to control, we have what something, or we have arrangement called further acquisition. And we also have what we call partial disposal. Now, so under the control to control, these are some of the events that can happen. So here, control to control here means that the company had already acquired a company. So the parent can take either of these two decisions. So control to control here happens when, under further acquisition, the parents decide to what, further acquire the subsidiary. When that happens, they will increase their equity and they still control the subsidiary. And again, under partial disposal, that too, the parent owns the majority shares in subsidiary, and they can decide to what, offload or sell some of their equity out, whilst they still control the subsidiary. That's what's called partial disposal. We will talk about it. Now, the second event that can happen is called control to no control. This event is a situation where the company is a majority shareholder and they decide to what, sell all the shares to become an associate. So it means if the company is having 80%, they can decide to sell 40% of their equity shareholders. Then they become associate. That's what's called control to no control. So in this case, when that happens, they cannot do consolidation of accounts. And the last one is what we call no control to control. An associate that has what, additional equity shares of what, of the parent to become the parent itself, right? So here the company can hold 30% and now they can buy 40% in addition. So when that happens, they can now control the subsidiary. So these are what happens under what we call step acquisition. So these are the three: control to control. And a control to, we have further acquisition, partial disposal, and then we also have control to control, and we also have what, no control to what, to control. So let me pick them one by one. So let us start with what, control to control. So under control to control, I say we have what, further acquisition. Now, under further acquisition, what happens? Here, if the parent has 70% shares in the subsidiary, and the subsidiary now holds how much? 30%. So this is the initial acquisition. Now, when the parent further said that, okay, we want to acquire maybe further acquisition of 5% in the subsidiary. So that happens. When that happens, this is how the proportion is going to look. So you have the parent holding additional 5%. That gives it what? 75% here. And then the subsidiary now is what? 25%. Right? So this is what happens when there's a further acquisition of what? Of the asset. So that is what we call further acquisition. Under the further acquisition, I've already said, let us pick an example and work on what? Further acquisition. After that, then we look at the other option under the control to control. So here, when that happens, clearly you can see that though the company has further acquired share of the subsidiary, so it is still controlling the subsidiary. That is why we call it control to control. The next action that the company has taken, they are still in control of the subsidiary. That's why we call control to control. So let us look at example of control to control, how they can couch it in the question for you to solve. All right. So this is the question. Further acquisition. On 1st January 2014, Joyce acquired 75% of Efia equity shares for 52 million. Joyce further acquired 5% equity shares of Efia for 8 million. Efia had made profit since being acquired by Joyce of 10 million. Fair value of Efia is 32 million at acquisition. There has been no impairment of goodwill. Good. So here, in summary, Joyce is the parent that has stake in Efia. You see, so the parent is 75%, then Efia is how much? When we look at it, if this one is 75, then Efia is 25%. All right. Now, when the acquisition took place, the equity share of the parent is 52 million, and then the equity shares of the subsidiary is 32 million at acquisition. During the period, and you also agree with me that when a company acquires a subsidiary, whenever the subsidiary makes profit, right, the profit is shared between the subsidiary and the parent. So before the further acquisition, the company had already worked. The subsidiary had already worked and made profit of 10 million. So that is the summary of the question. All right. So So this is the example and the solution. So here we have the parent. Let us summarize it. The parent was Joyce. Now we have also the subsidiary. And the subsidiary is who? Efia. All right. So under it, the parent has equity of 75% in the subsidiary, and the net asset during the acquisition, right? The net asset in the parent is how much? 52 million, according to the customer, right? Now, when we also look at the subsidiary also has 25%, and the equity shares in the subsidiary is how much? Is 32 million in the question. What did they say? They said that before further acquisition, the subsidiary made profit of how much? 10 million. Is that not the case? So that is what is in the question. So it made profit of 10 million, right? Now, what happens? They also said that further acquisition, what happened? In further acquisition, how much was acquired?
5%.
All right. Equity. So there was a cash consideration of how much? 8 million, right?
Yes.
And then acquisition percentage was how much? Percent. Is that not the case? So this is the summary of the question as you see it. So this is a summary of the question. So when you have it like this and it is control to control under further acquisition, what happens? The question says that under further acquisition, or further acquisition journal entry. So further acquisition journal entry, this is what happens. You will pick what is what? You will debit non-controlling interest with what? With the amount. Then you what? This is what? Other. Equity. Other equity component. So the difference here. Then here is your cash. So that is what you credit it. So that gives you this. So this is the journal entry. When you are doing further acquisition, this is what happens. So you pay attention here. The non-controlling interest was 25% during the acquisition, further acquisition. So under it, they said that the net asset at acquisition was how much? During when the company, so it means what is the equity value? You understand? The equity value of what? Of non-controlling interest in the question was 32 million. You understand? So when they were coming to further acquire the subsidiary, the fair value of the net asset of the company was 32 million. So this is let me explain this thing. When you are preparing statement of financial position, you see under the equity, you have what? Share capital of the parent, right? You have what? Retained earning. You will also have maybe if valuation surplus, or you have capital surplus, or you have what? Income surplus. You bring them. Then you will come and have your non-controlling interest account under the equity. Do you understand? So whatever you have it here. Whatever you have it here is a what? Is the net asset of what? Of the subsidiary. Do you understand? So that's the asset of the subsidiary. It belongs to the subsidiary. That is their stake in the what? In the total equity of the company. Do you understand? Okay. So it shouldn't be anything strange when you see it here. So then the net asset attribution that you see here is the what? Is the capital that the company has of the what? Of the parent. So far, this is what the company has. Now, they said that the company made profit. Before they made profit of how much? In the question, they said they made profit of how much? Before they made profit. So they made profit, right? So that profit you add, right? They made profit of how much?
10 million.
So because and you remember that this 10 million will be shared between parent and then what? And subsidiary. So it will increase their what? It will increase their value. Do you understand? So here, how do you share any gain on what? On their investment? How do you share profit on their what? On their assets? Here, when you pick the non-controlling interest, or when you pick the what? When you pick the subsidiary, where will you what? Where will you enter their what? Anything gain or loss that comes to them, you what? You enter it under their what? On non-controlling interest what? Account. You understand? Now when you also pick the parent, where do you share their gains? You also share their gains. Absolutely. You also share their gain in what? In retained earnings here. You understand? So that is what is at play here when you look at this one. So here there's a profit on the asset. So here they want to tell you that before you effect the further acquisition that will affect their equity interest, you need to add the profit to their equity. You understand? So here they have 10 million. You multiply their stake. They have how much stake? 25% in the company. So when you multiply, what do you get?
2.5, sir.
Thank you. So you have 2.5 million. You add. That gives you what? 34.5, right? So this is what the value of what? Of the parent and the subsidiary is. So in this instance, if there's no further acquisition, this is what you have been representing in the what? In the equity under the what? The line item of non-controlling interest. Do you understand? So here, they said that subsidiary has further sold 5% of their stake. You see the whole thing. So if they further sell 5% of their stake, what happens? You understand? Their value will reduce because this is your value, and you are selling 5% of it. Don't you think it will affect their value?
Sure.
Okay, so this is how it goes. So when that happens,
Yes.
this is what you
5% of
say.
that amount you get.
So when that happens, this is what you do. You say you less what? Further acquisition. Now, when you are lessing the further acquisition, how do you less the further acquisition of what? Of 5%? You understand? So yeah, all you have to do is that you come here, then you pick. Please, how much is the subsidiary selling of? How much?
8 million.
No, like the percentage. How much are they selling of?
5%.
Good. So they are selling off what? 5%. So you pick your 5% of the subsidiary. And what is the total equity in percentage of subsidiary?
25.
25. That's all. That's what I want you to tell me. So the total equity shares of what? Of the subsidiary is what? Is 25.
Yes, sir.
Aha. So now you have what? 25. So you have what? How much are they selling? They are selling off 5%. Right. Divided by their what? Divided by their total equity share that they are holding. Then you multiply by their total equity value. How much is the total equity value?
So it will be 34.5.
Okay, so that is 34.5. So when you multiply, what do you have?
6.9, sir.
6.9. Or less from what? From their what? From their total. Because they've sold this. So they sold 5% of their total equity. You understand?
Okay.
So when you sell it off, what is the value left? What do you have left?
27.6, sir.
27.6. So this is what is left for what? For the subsidiary. So now that we've had, so this now becomes what? The value of what? Of the non-controlling interest. So now this becomes what? The value of what? Of non-controlling interest. That will appear in the what? In the books of what? Of the subsidiary under the equity. Do you agree with me? Okay.
Yes, sir.
So when you are done, then you pass it through what? Journal entry. Now, when you are passing this through journal entry, this is what happens. So the non-controlling interest dispose of how much? 5% of what? Of their equity share. And the value is how much?
27.6.
No, the value is how much? Watch here. The 5% value is how much? They dispose of 5% of their equity, and the value is how much?
Okay, the 5% that was disposed of.
Yes.
6.9.
Thank you very much.
Oh, 6.9.
You said 6.9. Okay, so
yes, sir.
Okay, that's fine. So 6.9. Okay, so here you'll bring your word, the non-control. This is how much the 5% that they dispose of, right? Value.
Okay.
Now, how much was paid? How much was paid?
For the 5%, we paid 8 million.
You paid 8 million. Right? So the difference is what we call other what? Other
component.
Which is what? The difference is how much?
The difference 8 minus 6.9. 1.1, sir.
1.1. Are you with me? Good. So that is it about the further acquisition. So when this happens, right, you are done. You've done this. So you realize that when you have your equity, and again, you somebody would have asked, okay, so this you have your what? So when you have your what? You have your what? Your equity. When you have your equity, this how within your equity share, this what is going to happen, right? You have your what? You have your share capital. How much was the share? How much was the share capital before acquisition? How much was it?
For acquisition?
Yes. The parent, we have share capital.
Parent, 72.
Oh, 72. Where is it? I can't see.
No, 52.
So that's 52 million. If you have what? Retained earnings, right? You have your retained earnings. The question didn't provide those things for us, so we are limited. Yes. So if so, the retained earnings will have what? 10 million cash that they made profit. Multiply by the
The
parent is
parent
75%.
percent.
Yeah, and so whatever you get, you add it to the retained earnings.
5.
Now, are we seeing that other equity component? It will come here,
Okay.
which is how much?
1.1, sir.
1.1. Then you will come to the what? The NCI, non-controlling interest. How much is now the NCI? 27 point what?
6.
27.6. Do you understand? Remember, the
Yes,
cash
sir.
that they paid for, you see, the cash that they paid for, that 8 million, will not appear in any of the books. You understand? At best, this cash will be removed from what? From investment. You remember when we were doing, we were determining the goodwill of what? Of company. You remember? The cash, when the
Yes,
cash
sir.
is paid, it is what? It is removed from what? From
It is
investment.
taken out.
You understand? So that is how
Yes,
the
sir.
entry is done. Any question? So this is how it will look.
I'm okay with it. I'll run through.
This is how it will look. Thank you very much. Okay, so let us look at the second question. All right. Now let us go there. So here you can see that like on 1st October 2016, who acquired 60% of equity interest of Sunyana, a public limited company. The purchase consideration was 40 million. Who disposed of an 8% equity interest in Sunyana on 30th of September 2018 for a cash consideration of 9 million, and had accounted for the what? For the gain or loss in the what? In the what? In the income statement. So underline this for me. Underline it.
Okay, sir.
You understand? And had accounted for the gain or loss in other income. So the carrying value of what? Of the net asset of Sunyani Limited at 30th September 2018 was 60 million before any adjustment on what? On consolidation. So this is the carrying amount of what? Of the company. They said that who subsidiaries, investment in subsidiary, you see, who account, and underline that one too for me, who accounts for its subsidiary instrument in what? In other comprehensive income. Do you understand this statement? What they mean
No,
is
sir.
this. What they mean is this. You see, when you have subsidiary, okay, so I will demonstrate it on the Excel for you. All right. So that is it. And the carrying amount of what? Of the investment in Sunyani was what? 45 million at 30th September 2018. And then now the value of the asset is now what? 47.5 million at what? At September 30th September 2018, before the disposal of what? Of equity shares. With this one, what do they say? The parent, this is the parent. The parent has what? The parent has how much? 60% equity.
6%.
You understand? In a subsidiary, right? So if the parent has equity in subsidiary, that is our interest here. So if the company has 60% in subsidiary, then we assume that the subsidiary is how much?
40, sir.
Right? Okay. Now, when the company bought a subsidiary, how much did they say they bought it? At how much?
60.
At 40
They bought
million.
it at 40 million.
40 million. They bought it at 40 million. That's what they mean. Okay. Now, they said that they did what you call partial disposal. Have you seen that? They did
Yes,
partial
sure.
disposal. The reason why we call it partial is that partial disposal of how much? 8%. Is that they
3%.
didn't dispose majority of their shares. You understand? They just disposed of fraction of what? Of their shares.
Yeah, shares.
The reason why they can still, though they've sold part of it, the reason why they can still what? Control and consolidate the subsidiary. That's what we call what? The partial. So here, the basis of what? Being control and selling part of the equity, and again still control the subsidiary. You understand? There's one this one
Yes,
falls under
sir.
control to control. Okay, now In the question, they further also stated what? They further stated something in the question. They also said that the company, the parent
Yes, sir.
investment in subsidiary, listen very carefully. The parent investment in subsidiary
Using
in subsidiary is accounted for using what? IFRS what? 9. You understand the statement? You see, using IFRS 9. What this means is that when parent buys subsidiary,
yes, sir.
you will have what? The parents, and you have what? The NCI. You understand? So in their percentage, if this one is 60%, this one is what? 40%. You understand? Now the parents will consolidate the NCI. So with the NCI, you will have your what? Under the equity, you have what? You have the share capital of the parent, right? Then you
Yeah.
have what? NCI of what? Of the subsidiary. Now, this NCI of the subsidiary that you have in the what? Equity. That is what the parent, the question is saying that value, if the value is assuming 40 million, they said that they account for it using IFRS 9. What it means is that when there is a gain on this asset, when there is a gain or there is a loss on what? On NCI, it will pass through what? OCI.
Right.
So that is why at the latter part of the question, I said that you should underline that portion because it will come up. And again, I made you underline something here. The gain, I had accounted for gain or loss in what? In other income. What does this statement mean here? You understand? What this statement means is that when the company disposed its equity, like partial disposal of 8%, is what they are talking about. So they accounted for, you understand, they accounted for the disposal of what? Of the 8%. You see? How much did they dispose? They disposed 9 million. And they say that they've accounted for the gain or loss in what? In other what? Income. The principle under this is that when, let me note this one here. Note it under control to control disposal of equity, whether there is what? Gain or loss on disposal, they are not recorded in the what? In the profit or loss account. Under control to control disposal of equity, whether there is gain or loss on disposal, they are not recorded or treated in the what? In the profit or loss. You understand? Ideally, when there's a gain or loss, it goes in the P&L as what? As income or gain on what? Gain on disposal. You understand? But here, the principle is that they are not recorded. Such arrangements are not recorded. Why? Why are you not asking why are they not recorded? They are not treated in the what? P&L because the parent has not lost what? Control of the what? Of the subsidiary. Do you understand? We don't treat loss or gain of what? Of disposal in the what? In the profit and loss account because the parent has not lost control of what? Of the subsidiary. You remember that parent and subsidiary don't transact and make profit. Have you forgotten? Parent and subsidiary
they don't have business.
They don't do business and make profit from each other. Have you forgotten?
Yes.
So
because it doesn't make. I'm okay with because they need not to do because how can I sell to, let's say, my brother, which we are in the same business, and say I'm going to make profit? Natural law doesn't even agree. You either discount. That is why we have related party.
Good.
So you need
So
to
that's
disclose.
why I'm saying that. So when that happens, we don't treat it in a what in a P&L because the control has not lost yet. So you can't go and
Exactly.
treat the loss profit in a what in a P&L. So that's the reason why I said you should underline this statement. Had
Yeah. Gain
accounted for the
loss.
gain or loss in the other income. So clearly, if the question looks like this, it means they have already treated the what? The sale of that 8% in the profit and loss account
Already.
because they said the certain they had accounted for it. So when that happens, what do you do? If they are accounted for, what do you do? If they
If they
are
have accounted,
for it, what do you do?
then we need to disclose it.
No, you go and remove it. Hey, what are you doing?
Okay.
Are you doing disclosure accounting? You go and remove it. If they've accounted for it, go and remove it from what? From the
Okay.
P&L.
From P&L. Okay. Thank you.
Okay, so that is what I want to share with you on this particular question.
Thank you. 3.
Okay, so again, when there is any fair value, so watch here. In the question, they also said that the NCI is what? Reported using what? Using IFRS what? 9.
NCI
You understand?
9.
9. So here, if assuming like beginning, the fair value of what NCI is 40 million, at the end, it is now 41 million, right? There's what? There's a revaluation gain here. So there's a revaluation gain on the asset here. So this revaluation gain, what do you think? Because remember, so the current value of what the investment in Sunyani was 45 million at the beginning, and at the end, it is what? It is 47.5 million. You understand? Before the disposal of equity interest. You understand? Before the disposal of what? Of equity interest.
Okay.
So how do you treat the difference?
The first one was 45, 2.5. 2.5, we have to take it out.
We have 2.5. Why do we take it out? That's what that I want to hear.
Yes, I'll take it.
Let us start with the solution straight away. Then we are done with control to control. Okay, so the solution. I've already summarized the whole thing for you. So the solution. So we'll come. Who is the parent, right? And it has what 60% was stakehold in what in Tsunami. Is that not the case? How much did they sell equity? Yeah, they sold how much? 80%, 8% of what? Of their
8%.
equity in what? In Tsunami. You understand?
Yes.
They sold 8% of it. How much did they get?
The one they sold, the 8%, they had 9 million.
They had 9 million. So let's represent it before 9,000. You understand? So this is how much what they sold.
Yes, sir.
Okay. So now everything before you want to know whether you lost or you gain, you should compare your proceed with what? Of your cost. Do you understand? Before you can know whether you gain or you lost.
You are losing.
If you don't know, how will you know whether you
You are losing or
you
gaining.
are losing or you are gaining. So when did they dispose of this investment in what? In Tsunami? When? 30th September 2018. Disposal was done 30th September 2018. Okay. And they disposed this. And remember, the total value share of what?
Yes, sir.
The total value share of what? Of who in Sunyani is how much?
The total value of share.
Yes, equity share
60%.
60%. And they out of 60%, they sold 8% of that.
So they are left with 52.
You understand? So now this is how you will do. So first, what is the actual fair value of what? Of Sunyani right now in 60% of what? Whole in Sunyani. What is the actual 60% of what? Of whole in Sunyani? What's the fair value? That's the question. What is the fair value? Read it again. When is that? Watch it. When are they disposing?
Okay. They are disposing in September, so it is 47.5. September 2018.
Thank you very much. So what is the fair value of what? Of the net asset of what? Of the stake in what? Subsidiary of Tsunami.
Yeah, so that is 47.5.
Thank you very much. So here, the 60% that you see, watch here. the 60% of the parents who
Yes, sir.
the value of this 60% in Sunyane is now what? 47.5 million. You understand now? The fair
Yes,
value
sir.
of what? Of that 60% in Sunyane is now 47.5 million. Right? Now, out of this 47.5 million, they sold 8% of that. And so if you know the fair value of what? 60%. Are you with me? If you know
Yes,
the
sir.
fair value of 60% in what? In Sunyani to be of 47.5 million. What will be the what? The fair value of what? Of 8% in out of 47.5. That will represent the cost. You understand? That will represent. So
Yes,
assuming
sir.
that they are selling all the 47.5 or maybe or they are selling the 60% off. The fair value of what? Of that would have been what? 47.5 million. You understand? So if the fair value of it is 45 million, they may sell it at maybe 50 million. Then we can what? Or we will know that this is the cost. Then we less the what? The proceed of 50 million. Then that will give us profit or gain or loss.
Small money.
You understand? No,
Yes.
I want to draw your attention to something. You understand?
Yes, I'm getting it. Yes, sir.
So if assuming they want to sell all their stake in what? In Sunyane, 60%. The fair value have been 47.5 million. Now, the core price, maybe how much are they selling it? Maybe they sold it at what? 50 million. So here, this would have been our cost. And our proceed, this would have been our proceeds. 50 million would have been our what? Our proceeds. And then the cost of what? Investment would have been 47.5 million. Then we will get our profit or loss. You understand? Now, in
Yes,
this
sir.
instance, they are not selling it all. They only sold 8% and they earn 9 million. How do we get our cost of investment? You understand? That's why I gave you this ratio. If 60
Yes.
million percentage is what? Is equal to 47.5 million. What
Five.
will be
Therefore,
the 8% of what? Of that? What will be the what? What will be the what? The
8% portion.
portion of what? 47.5 million. That is the
Yes.
idea that I want to plant in your head. So this is simple ratio. So here, if you like, I can give you ratio, right? I can say 60 is equal to 47.5. Now 8% is equal to what? Y or X that you don't know.
6.3.
8 will be what? Will be what you don't know. So all you have to do is listen very carefully. I just want to give you some idea. So all they have to do, then you can do what? Cross multiplication, right? Right. So you say 60x is equal to, when you multiply this one by this, what do you get?
You get 380.
380. Like this.
380. 380.
Then you divide both sides by 60. You divide both sides by 60. What do you get?
6.3.
Please, do you understand? Do you follow the analogy?
Oh, yeah. I get this one.
So what do you get? You get what? So x will be what? 6.3. I hope you follow this simple thing that I just
yes.
So the same thing applies here. So the reason why, so maybe in some book they will just go straight forward for you, but I will not do that. I want to break it down for you, right? So here, in order to get the cost of what? Investment, I will say, they will say 8% over what? Over 60% multiplied by the cost. I said the cost is what? 47.5. So let us make it 47,500. Do you understand? Because what we've done here is the same as 8 over 60.
Yes, sir.
It's the same thing. So when you multiply, what do you get?
6333.
So 6333, right?
3.
Like this.
Yes, sir.
So when you less it, because you see that the proceed is more than what? The cost. So that gives you what? Gain on what? On investment.
2667.
So this is what? Gain on investment. Simple. You are done, right? So this thing that you did there, you divided and you had 6.3. When you add the zeros, it will equivalent to a 633, right?
Yes, sir.
Okay, so it's the same.
Thank you.
So you see that I've broken it down for you. So that is it. That is it. That is the partial disposal.
Disposal.
You understand? So at the end of the day, you realize that the equity, at the end of the day, what do you have here? You will have parents, you will have parent value now reducing to what? How much? The parent, the whole is now how much? 60% minus 8%. That gives you what? 52%. Is that not the case?
Yes, sir.
So that's what will be left to what with parent in the stake of what of the subsidiary of who. So here, when you come here, because this gain on investment, they've already recorded in their other income in the P&L. That's what they said in the question. In the other income in the P&L, they've already recorded 9 million as what? As a gain. Do you understand? They've already recorded it.
Yes, sir.
Right? So there's the standard. So this is the proceeds. So they said they've already recorded this gain in the what? In the profit and loss account. So when you come and less this 2667 from the book in the P&L, you will less it. Because they've already recorded it. They are not supposed to record it because the parent is still in control. So that is the idea that I want you to understand here. Are we on the same page? So that is it about this one.
Yes.
So that is it about this one. Are you with me?
Thank you, sir.
Good. Then you come to the next item. They also said that there's what the whole account for investment in subsidiary using IFRS what? 9 financial instrument. Do you understand? So gain or loss on what? On the asset is what? Is also recorded in the what? OCI. So when you look at the question also here, you realize that the fair value of what? Of NCI is how much? At the beginning, it was what? 45 million.
40.
And now, so this one is 2017. And now fair value of NCRs now in 2018 is now how much? 47.5 million. So when you less, what do you have? You have 2.5 million.
5.
They said this 2.5 million what? You also go to OCI and remove it. You remove this what? 2.5 million from OCI. Why are you removing this OCI? Because so whenever there's a fair value gain on it, it cannot belong to the parent. Are you with me?
Yeah.
So this one too will be removed because